My name is Ryan Duffy Bierley. Thank you for coming. I'm class of 1998 appointments. I'm the owner, sole employee, marketer, salesperson, accountant, investment advisor, life insurance agent at Bierley Financial Services. So I've been in business now a little over 2 years. In the last 6 months to a year, I've become an investment advisor representative. So I changed my practice from a broker-dealer using some older securities licenses I had to now I'm an investment advisor representative. And I just wanted to introduce the group to kind of what I do a little bit different than some investment advisors or financial advisors that you know and work with, and just go through one of the investment advisory companies that I work with for wealth management. And what I'm really excited about this opportunity is not only can people use it for their own retirement, their own IRAs, their own money. I'm actually affiliated and appointed with there's 100,000 different 401ks, 403bs, and I'm also appointed with the New York State Deferred Comp Plan. So if someone's an employee of the Monroe County, an employee, a school teacher, someone that works at the University of Rochester, I'm able to actually advise their plan for them.
Sorry about that. How you doing? How you guys doing? Good?
Morning.
Grab a seat. Morning, how are you?
Good, how you doing?
Good, good. How you doing? How you doing? When? How you guys doing?
Good.
Good.
So I'm excited because as an investment advisor now I have a relationship with 100,000 different 401k providers. So Fidelity, Vanguard are big ones I work with. In the 403b market, TIA Trust, or any school district, and the city of Rochester, Monroe County, I'm actually able to manage their deferred comp 457 plan. So I'm really excited about that. A lot of people, there we go. A lot of survey after survey says people want help with their retirement plan. That's where the lion's share of most people's wealth is. And unfortunately, that's where they get the least amount of help, and that's where they have the most amount of their money. So in the past, as a financial advisor, I work with people. I certainly helped them with their plan, but I wasn't actively working with them quarter to quarter to build their wealth with their plan. So now it's a huge advantage for my clients because there's not a lot of help out there. They might have a guy or girl that comes to see at work. They say, hey, how old are you? This is your risk tolerance, and then they throw in a bunch of mutual funds, and that's kind of like it. So the advice I provide is active management, which is what we're going to be talking about today, and managing risk versus managing return. So before it was just, hey, we'll set you in a great portfolio, we'll diversify, all these words you've heard before. Well, what happens when the stuff hits the fan? What happens when the market goes down 20%? We'll write it out and it comes back, it always comes back. Well, I was kind of sick of that as an answer. So there's a lot of things you can do to preserve the money that you save in your retirement plans and then actually make more return in your retirement plans by taking on actually less risk. So what I wanted to pass out and talk about today was just one of the investment advising companies I work with, and it's Flexible Plan Investments. They've been around since 1981. They manage about $2 billion in assets. They're a top 50 investment advisor firm in the United States, so they're really good at what they do. They're out of Bloomfield, Michigan. One reason I gravitated to these folks, they're so highly rated. They're experts in risk management and active management for portfolios. What was really exciting about it is they're such a great company, and they do such a great job in this risk management. They're actually approved for the New York State Deferred Comp 457 plan. So someone that has a deferred comp plan, and they have, say, $100,000 in their deferred comp plan, and they're in mutual funds and different bond funds that are in the plan. That's a buy and hold strategy. So you buy it, you hold it, it goes up, it goes down. Well, now what the state is allowing you to do is actually allocate 50% of your deferred comp account value and put it in an active managed account and have an investment advisor like myself manage it for you. So it greatly reduces the amount of risk that you're taking, and it's kind of the best of both worlds. You have the low-cost buy and hold philosophy using the funds that are available in your plan, and then with the other portion in the deferred comp, actively managing strategies that are reducing risk and giving you great returns. And there's a great white paper that just came out from Vanguard that actually describes using low-cost ETF funds and mutual funds, setting them up, letting them ride, and then using a active managed portfolio with an investment advisor for the other half of your money. So it's kind of a unique piece I found that works perfectly with the deferred comp system. So this plan is available for people that are saving for retirement, in retirement, or if they're specifically at the state or the county or the city, they can actually utilize these plans. So if you guys open up, one thing that's unique is its dynamic risk management. So what that means is responding to shifting market conditions. That's a big one. There's over 30 things that each strategy looks at to make sure the amount of risk that they're taking is appropriate for the client. So they do what's called a crash test report with things like inflation, stagflation, deflation. Is GDP going up? Is GDP going down? Is GDP going sideways? Is the stock market going up? Is it going sideways? Is it going down? Is gold going up? Is gold going down? Is gold going sideways? So there's so many different variables they're looking at to manage the risk. So on the left-hand side is what every person that enrolls in this program with me, and I help with their investments through this plan. It's flexible plan investments. You get what's called an on-target report. So this is very unique, and if you did this with your work plan, you would still get your statement from your Fidelity or whoever, and you'd also get a personalized report from myself. So this on-target report is awesome. So it takes into account how much risk the person's taking, where they're at in retirement, and where they need to be for their goal to get to where they want to be. So essentially, to hit your goal or hit your target reporting, that's 60% of the goal. So if you go down, you see the on-target monitor there. You see that kind of pie chart, or excuse me, the bar graph. You see the red, the yellow, and the green. So that the green, that yellow line right there, that's 60%. That's the bottom, 20%. So that's a person with a current portfolio of $264,000 in 2007, and it looks at the last 10 years. So they want to be at that number on the right, $448,000. That's the goal for 10 years. That's 60%, so that's the target goal. So that's what I'm managing the risk to hit that number. Like worst case scenario, we're going to hit that number 60% of the time. 20% of the time, we're going to outperform that number, and you can see the portfolio is $582,000. And then 20% of the time, we're going to swing and miss. And I stink at my job. I'm sorry for working with me for 10 years, but we didn't hit the goal. 20%, and it's not terrible, $389,000. But what it does is, quarter to quarter, you get this little line graph, this little squiggly line, and it shows you, where you are hitting your on-target goal based on the amount of risk you're taking in your portfolio. So it's a really unique thing to get in with your 401k plan or from your investment advisor, because it tells you exactly where you are quarter to quarter. And then any questions about that?
How do they actively work with you? Do they call you up or?
That's a good question. So before, as a financial advisor, I represented mutual fund companies, variable annuities, different investments, right? So I would say, hey, this American funds mutual fund is great, and I would sell it, and they would pay me a commission, and the person would own a mutual fund. So I would represent them. As an investment advisor, I'm an independent investment advisor. There's hundreds and hundreds of investment advising companies I can utilize. So before I utilized mutual funds and built portfolios for people, now I'm utilizing these different strategies a bit more. So there's different companies that do it. And for the retirement landscape, flexible plan is one I love for the New York State 457 plan. For Wegmans and for Wegmans and University of Rochester in the area, I have another company I love, Pacific Asset Management. They're out of the state of Washington, so it's plan specific, but that's how I got kind of associated with them. And just like before, you're building a portfolio, some big companies, small companies, some international exposure. Now I'm building with different strategies and managing the risk versus just the fund or the return. So if you look on this right page, folks, dynamic risk managed investing, and I love these. This like one pager to go over with you quickly. It says bull market 54% of the time. Well, that means 54% of the time you make money, right? Well, what about the other 16% bear market and 30% sideways market? So the opportunity working with an investment advisor, utilizing active management, is the 46% of the time the market isn't going up. You're only making money in a buy and hold strategy when your funds perform and the market's performing. There's a lot of opportunities to make money by actually taking on less risk, which is the strength of it, when the market's sideways or the market's negative. So if you look to the right, they call them black swan events, and that's my job as an investment advisor. When I started as a financial advisor, it was 2008. So I passed all my exams. I was all excited. I'm like, I want to be a financial advisor. This is the greatest job in the world. And then like 3 months, I come into work. Like 3 months later, there's people getting sick in garbage cans. There's people quitting, a divorce. One guy had a heart attack in the office. I swear, it was like insane. So I learned how to invest money kind of backwards, how to take on the least amount of risk and to hit your goals. So this is just really maximizing how I see how to invest people's money by taking on less risk. So these black swan events, 9/11, 2001, the Iraq War, natural disasters, the 2008 financial collapse, government defaults, and then if you go right below that, I just wanted to give you an idea, passive management versus active management. A big difference is the amount of money you lose in the downturn. Now you might not make as much money on the up market, but I'll show you in the next the piece of paper I'm going to pass out. It's about how much money you have in your account. I'd rather not make as much and not lose as much, but 10 or 20 years down the road, I have a lot more wealth I created because I didn't take on as much risk. So the compounding market cycles, market loss mathematics. You have $100,000 in a dynamically managed portfolio. You see that little box here on the right, and you lose 10%. Okay, so you have 90,000, and then year 2 the market shoots back up. You make 15%. So after the 2 years, you have $103,500. Okay. Passive management is buy and hold. This is what you saw in the 2000s, and this is what you saw in 2008. You bought and held on to stuff, and then the world came to an end, right? You lost 30%. Some people lost over 50% in their 401ks in their IRAs. So you take that same 100,000 passive management, you lose 30,000. You only have 70,000. Well, let's say the market comes back. What people don't realize is when you lose money, you need a lot more. You have less money. So if you lose, 25% of an account, you need like almost 40 to get back to even. So if you have 100,000 and it gets cut into 50,000, you don't need to make 50%, because 50% that's not going to get you to 100. You need to make 100%. That's what a lot of people don't realize. So avoiding these black swan events and avoiding these big losses makes for a lot smoother ride towards retirement and more predictability. So you see that even the next year in the passive management, the market shot back up and you made 30%. But you made 30% on the 70,000. You only had 91,000. And then I help manage investor expectations with the active management, with the on-target reporting. It's just a little slide on that. Any questions about any of this stuff? Anybody here?
So if I go ahead.
No, you can go ahead. I'm thinking of it.
If I've got money sitting in a retirement fund.
Yeah. Now, is this in an IRA, OJ, or is this at a former employer or current employer?
Either one. I guess
Okay.
Tell me because my question is, does the money come out of that fund to go to you? And I say, or do
That's a
you
great
work, or
question.
do you work with that money in the fund?
Great question. So, and this, you see, it's...
Or then maybe it's in for an IRA as opposed
Yeah,
to...
great question. Let's say a worksite plan. You have, like, for instance, just as an example, for University of Rochester, they have TIA Prep, right? What did I do with it?
Finance Institute of Rochester, TIAA Prep.
Yeah, so what they allow you to do is open what's called a brokerage window. I have it somewhere here, I'll show you. They allow you to open a brokerage, of course it's right there, a brokerage window inside of your actual account. So you would have your, like I just did one yesterday for a physical therapist at the University of Rochester. We open up a brokerage window, he has his TIA retirement, and then we fill out paperwork to open up a brokerage window inside of his account. Now I can either actively manage the funds that he has inside, that he's already using, or I can add these risk, actively managed portfolios into his account. So the account doesn't change, you still have Fidelity, or you still have Vanguard, or whoever your retirement plan is. They just have an option inside them that nobody knows about. Like 90% of people that have this aren't utilizing it, and that's why I'm excited to start doing it, because not many people are doing it. Because they think, oh, I have Fidelity at work, the guy or girl comes once a year, I'm doing okay, Fidelity's a great company. Well, it is a great company, but when I work with Fidelity as an investment advisor, I'm going to give you a lot better return than you trying to do it on your own. And I can add other strategies into your 403b or 401k. So it's a great question. So basically, it's called a self-directed brokerage account. So you open up a brokerage account inside of your 401k or 403b.
Is there a limit on how much you can use for that?
That's a great question too. Some companies limit how much you can transfer. The New York State deferred comp, you can only do 49% of your plan. Why? Because it's New York State. They're the only ones that, right? Enough said, you're an accountant. Right, New York State. So they allow you to transfer 49% of your account balance. So I did one for a state trooper this week. We sat down, he had like $60,000. We put about $25,000 in my managed portfolio, and we left the rest of the money in the Vanguard and Fidelity and other funds that I set up for him. And what's great is you have a two-horse race. You have the buy and hold strategy of the ups and downs, and then you have someone actively manage your portfolio on the other side. So they limit to 49% or 50%. Fidelity and TIAA, they sometimes limit, or sometimes they say you can do the whole thing.
Is that with new money too?
Yes.
New money coming in.
So yes, so your yeah, that's a great question. So with your contributions, as you're dumping money in, for the client, it doesn't change. I'm doing my 5%. That 5% will just go to your funds, and it would go to your brokerage window I manage, however it's split up. So for the client, it's easy. It's really just paperwork, and they just continue to save like they have done, and it will allocate it to the two different accounts.
And forgive me if I missed, I had to get glasses so I could read. Is there a limited, is it like open enrollment with health insurance?
That's
And
a
you have to,
good question, Chris. There's no open enrollment. You can do it at any time.
Okay.
So it's really whenever I sit down with a client and they decide, yeah, this makes sense for me.
Okay.
What I've been doing and trying to do is like work site, like my friend that's I call him a personal trainer. He gets so pissed off because he's not a personal trainer. He's a physical therapist. He has 2 master's degrees, right? So I always call him a personal trainer. He's like, I'm a physical therapist, like whatever. So he's insecure about it. So he
clearly.
yeah. So like for him, I helped him out at University of Rochester. I like to like now that he sees the value in it, he'll invite me in, and maybe I'll meet with 4 or 5 of the people, because they all have the same plan. That's the great thing.
Mm-hmm.
And if you're not getting service, the person sitting next to you is not getting service. Your friend at lunch isn't getting service. No one's getting help. So I use my clients kind of to spread my gospel of the active management and the self-directed brokerage account.
So you're not changing any of their IRAs, you're just actively managing that account that they have.
That 401k, yes. And I'm either managing the funds that they have and putting together a risk adjusted portfolio based on their specific needs. So I sit down and do a risk assessment, figure out the proper way to invest for them, and that allow you to manage the funds that they have, and then other companies allow you to manage the funds that they have and add different strategies like flexible plan or another investment advisor to their current plan. And then lastly, I just wanted to show you any other questions? Those are great questions.
So we mentioned the maximum in New York State obviously be 49%. Is there a minimum either amount or percentage?
Good question. Usually, I mean, I'd say like $5,000 for most. Like for an IRA, it's like $5,000. The minimum transfer to go from one to the other with like TIAA and other ones is $1,000. And really, if you're only going to put $1,000 over, it doesn't really make sense to do it. It's more they don't want you changing in and out constantly, because it's not for like actively trading.
Yeah, it's not an e-trade, day trading kind of concept.
No.
It's a long term.
Yeah, it's a long term, and it's a good question. For an IRA, most strategies it's a $5,000 minimum, or for a rollover IRA. And then same for the 401k, 403b, or New York State 457.
For the IRAs, is there a contribution minimum that has to be met every year?
No. That's a good question. So so somebody that, you know, for 2018 that needs to make their contribution, they can open one new, and then put in 5,500 for new money for 2019 too. Or consolidate old IRAs, 401ks, you can use this type of program. How am I doing on time? Okay?
Yeah.
All right, do about maybe 5 or 10 more minutes? All right. I'm sorry. This is an illustration I want to show you. Now that you hear my gums flap, what I do, how it works. Let's see. Where's let me see the numbers.
Yeah.
Like that's all I care about.
Yeah.
How much more money do I have if I work with Bierley Financial Services versus the jamoke they send out to your workplace? But that's another thing. All right, so this is a hypothetical research report. So what I did is this is from, it's a lot to look at. I'm going to, from left to right, read it for you so everyone's eyes don't cross and we get migraines going to our next meeting, right? So the top left corner, these shapes and icons, those are the different strategies, indexes, or portfolios I'm using. And if you go right down below that, you see your capital market line analysis. You see that graph, guys?
Mm-hmm.
Okay. Now, the left side right here, the return, and then the bottom is how much risk you're taking on, right?
Mm-hmm.
So that bottom left corner, you see it says 00 T-bill? Okay, so what a T-bill is a treasury bill. That's considered in the investment world as zero risk. It's backed by the government can tax us. God willing, they don't go out of business. So a T-bill is the least amount of risk you can take, okay? Now look at that red line, that's the risk spectrum. As it goes up, at the end, you see the SP 500. That's how much risk, if you own the S&P 500 index, you put your money in an index fund, it sat there for 10 years, it goes up and down with the market. So now if you go up to about 10% and then go up, you see the bullseye there, portfolio? What that shows is the amount of risk that this portfolio takes on versus the amount of return. So if you can see, we're taking less than half of the risk of the S&P 500, and our return is significantly higher than the S&P 500. Well, that's what we want. That's the story I'm trying to tell. Take on less risk, don't lose as much money, and make more money when the markets perform. The top right corner, you see portfolio strategies. QFC, market leaders balance, evolution plus growth. These are all different strategies that I use within flexible plan. There's 100 of them. I use about 12 of them, usually like 6 to 8 of them, depending on the client. And you see the different percentages, okay? Then you got the comparative growth. I did $200,000 invested, and this is exactly what happened. You know, $200,000 invested in the S&P 500, January 2007. And then I invested $200,000 in this portfolio, and we did a side-by-side comparison. Something very important to know. We're going to start on the right here. It's 2007 and 2017. Does everyone see that? The below? Okay. Something very important to note is the portfolio on the right, the S&P 500, that is zero fees, expenses, and everything. That's when you put on the news, it says S&P 500 up 5%. That's not including an investment fee, a commission, or anything. So that's just the index without even any fee. The portfolio on the left will be run at 1.8 to 2%, which is the maximum fees and expenses I can charge a client. So I can't stress that enough. The portfolio on the right is the least expensive portfolio you could have. There is no fees, and then my portfolio is at my maximum fee. Now my fee is I generally charge anywhere from 0.5% to 1.25%, depending on how much work I'm doing for the client and how large the account is, essentially. So let's look at the side-by-side comparison. And so in 2007, it was a good year. The portfolio made 11.8%. Everyone see that? End of the year, you had 223,000. The S&P did 5.5. Everyone see that? 210,000. Well, what happened in 2008? I crashed the stock market by passing my my securities exams, and everyone got scared, and I destroyed the entire economy. So in 2008, 37%. The S&P, you had 132,000. This portfolio made 2.7%. So just to reiterate that, right? The S&P lost 37%. This portfolio made almost 3%. Now, we talked earlier how long it takes for compound returns, how much more return you need to get back to even. Look at the start of 2008, 229,000. The next year, 09, this portfolio was positioned to make money. It was actively managed. It's not just sitting there waiting, worrying, wringing the hands, you know, looking at your cell phone every 5 minutes, hoping the market goes back up. No, they're in a position, actively manage the portfolio with these strategies I'm showing you. 2009, 36.6%. What did the S&P do? 26%. So now let's look at 2010, your actual dollars. This is the big difference. 380,000 versus 193,000. That is huge, huge, because you can never get that back, and the closer you are to retiring, the less amount of risk you can take. So what happens is people get too conservative, and they miss opportunities, and then they run out of money in retirement, essentially. So this allows them to stay invested and take advantage of tons of opportunities with all the downside protection. And if you go through it, some years, you know, the S&P beats this portfolio, but I don't care. I don't care if the S&P does 20 and my client only makes 11. That's fine. Because when the market goes down 20 and my client loses 5 or makes a little bit, they're going to be way better off. And if you look at the final numbers, that 10-year snapshot, the portfolio went from 200,000 to 771,139. The S&P 500 was 525,000. Over a 10-year period, almost, you know, $200 more thousand.
You're looking at 4 years here to get back to even.
Yeah.
Or the way you were saying there.
Yeah, great. That's a great point. To get to like what George was saying, if you go down the S&P 500, to get back to that 200,000, 2011 you got 197. 2012 you finally dug out of that recovery. So that's a great point.
Wow.
How long it takes you to dig back out to get to even. And then this can get a little wonky. There's a lot to look at. But one thing that I do as a financial advisor, as an investment advisor, on the left here, see the S&P 500, and it says beta. Well, the beta, that is whatever the market does, is 1, right? The alpha is 0. What alpha is I'm alpha. I'm the alpha. I add value to your investments. I add value to your retirement accounts. I hold your hand. I make sure you don't do dumb things when the market goes down, more importantly than doing smart things with your money. I help people not make mistakes. And the alpha that someone like myself adds, if you look at the portfolio, alpha is 9.2%. That's the extra value, the extra added return that was added by working with myself and as an investment advisor. So you add that much more return. And then just two more pages, and I'll answer any more questions. This next one just shows you, you know, sometimes it's nice to see visually. I mean, look at 09. This is a black swan event. So the next one's going to come over here somewhere. They've been saying it for 10 years, 8 years. We don't know when it's going to come. But whether you're, 35 or 75, it's going to screw your retirement up. So having something like this, active management, it takes a lot of the sting out of investing. It gives you a lot more confidence, too. You're getting a quarterly report to show where you are on your goal. The last page, or excuse me, the second last page, I love this in investments. They call it, they have the positive and negative periods. Well, did you make money or lose money, right? Positive or negative period. So on the right-hand side is the S&P 500 rolling periods from 2007 to 2018. And I love they call it the maximum drawdown, something which I think is a funny word. Percentage of money I freaking lost. That's more appropriate, right? So the maximum was 12 months 43%. The maximum gain was 53%. So the total positive periods, there was 140 periods. Okay, 105 were positive, 25 were negative. Or excuse me, out of 130. And if you look at the percentage of positive periods, so there was 80% of the time it was a positive return. Now go to the left-hand side, my actively managed portfolio, there's the same 130 periods. Look at the total positive periods, 119. So you had 14 more quarters where you made money. That's huge, over 10 years. The total negative periods, 11. You had 14 times where you didn't lose money where the stock market lost money. So I like that because it just shows you the the percentage, and then the positive period is 91.54%. 91% of the time with this portfolio, historically, we've had positive returns. And then lastly, this just shows I blew up the risk spectrum again, just illustrating that this is your money in the bank, the T-bill. This is the S&P 500. These little dots are all the different strategies I'm using. And by combining all those strategies, you have a portfolio risk bonus by using non-correlated investments. So everyone's investments are correlated, meaning when the market goes up, you make money. When the market goes down, you lose money. Well, I use different strategies to hedge against that. Funds that hold gold, bonds, cash, and stocks. So the risk bonus that you receive, brings the risk down to less than 10%, and we went over the return. So, so thank you for your time today. Does anyone have any other questions about working with an investment advisor or how to use this with your worksite plan?
From what I'm seeing, is during the good times, it's maybe under, but pretty much on par with your standard S&P. Returns during good times might be a little bit less, but your loss is protected, if you will, during the bad times. And going back to, I think, is your most important point, you may make a few percentage points more during good times, but you're working with less money if you end up losing a lot, which you would not lose with an active managed account. So
That's
this
exactly
is,
right.
I want to say it's a safety net of sorts. Okay.
And this portfolio was a moderate portfolio. About 70% of this was in equities, and then the rest was in gold, cash, and bonds. So this was why I like using like a moderate for the risk management, because if we know the buy and hold strategy does well long term with some bumps, well, I'd like to be more aggressive with the side that's the buy and hold with the inexpensive funds inside the plan, or funds that somebody already owns. Well, let's allocate that, be more aggressive, and let that run, and let's put a portion in this, actively managed to reduce your risk, and have the best of both worlds, really. Because you have the low cost active management, you'll have some dips, but with the passive management, and then the active management, I like to be more conservative with that, because I'm not going to actively manage it and lose more than the S&P because I'm trying to outperform it. That doesn't make sense to me. So, any other questions? Thank you for